In 2008, the American housing market collapsed and took the global economy with it. 8 million people lost their jobs. 6 million people lost their homes. Trillions of dollars in wealth disappeared in months. It was not an accident. It was the result of a chain reaction, and every single person in that chain knew exactly what they were doing. Here is what happened. Number 1. The house. You want to buy a house. You do not have enough money to buy it outright. Almost nobody does. So you go to a bank. The bank looks at your income, your credit history, your existing debts. It decides whether you are likely to pay back what you borrow. If the answer is yes, it lends you the money. You buy the house. Every month, you send the bank a payment. The bank makes money on the interest. You eventually own the house. This is a mortgage. It is not complicated. It had worked more or less for a century. The key feature of this arrangement, the thing that made it function, was that the bank had skin in the game. If you stopped paying, the bank lost money. That meant the bank had a powerful reason to check carefully and honestly whether you were actually going to pay. The bank's financial health depended on the quality of its judgment about borrowers. Get it right. Collect 30 years of interest payments. Get it wrong. Absorb the loss. This incentive is what kept the system honest. Banks were conservative because conservatism protected them. It wasn't a perfect system. It excluded people it shouldn't have. It was slower and more cautious than the market wanted. And it made less money than what would replace it. But it worked. And then someone asked a question that changed everything. What if the bank didn't have to keep the mortgage? Number 2. The trick. The question sounds innocent. What if instead of holding on to the mortgage for 30 years, the bank sold it to someone else? The bank gets its money back immediately. It can turn around and lend that money to the next borrower, and the next, and the next. Instead of making one loan and waiting 30 years to collect the interest, the bank can make hundreds of loans and collect a fee on each one. Volume replaces patience as the business model. The problem was what it did to incentives. The moment a bank could sell a mortgage the day after writing it, the bank no longer cared whether the borrower could pay, not in any practical sense. The loan was gone. The risk was gone. The bank had already collected its fee. Whether the borrower made payments for 30 years or defaulted in 6 months was now someone else's problem. This is called the originate-to-distribute model. And it didn't just reduce the bank's incentive to check borrower quality. It reversed it entirely. A bank that holds its loans wants good borrowers. A bank that immediately sells its loans wants as many borrowers as possible. Quality becomes irrelevant. Volume is everything. So standards dropped. Quietly at first, then openly. Borrowers who would never have qualified for a mortgage in 1995 were being approved in 2003. By 2005, the industry had a name for what it was producing: ninja loans. No income, no job, no assets. Lenders were approving mortgages for people with no documented ability to repay them. Mortgage brokers were coaching applicants on how to fill out forms to get past automated approval systems. Nobody in the banking chain was going to be holding these loans when they went bad. So nobody in the banking chain had a reason to care if they went bad. But someone was buying them, hundreds of billions of dollars worth, which meant someone had found a way to make that risk disappear. At least temporarily disappear. Number 3, the bundle. The mortgages needed somewhere to go. Wall Street had the answer. Investment banks, Goldman Sachs, Lehman Brothers, Bear Stearns, and Morgan Stanley bought the mortgages from the lenders, bundled thousands of them together, and turned them into a new financial product, a mortgage-backed security. Instead of one bank owning one mortgage, thousands of investors could own a slice of thousands of mortgages simultaneously. The idea had a logic to it. If one borrower defaulted, it only affected a small fraction of the overall pool. Spread the risk wide enough, and no single default could sink the investment. Diversification, the oldest principle in finance, applied to home loans. But the banks did not stop there. They took those mortgage-backed securities and bundled them again. They sliced them into layers called tranches. The top tranche got paid first, safest and lowest return. The bottom tranche got paid last, riskiest and highest return. Then they took the riskiest slices, the ones nobody wanted, and bundled those together into a new product called a CDO. The CDO was where the trick happened. Because someone had to tell investors how safe these products were. That job belonged to the rating agencies, Moody's, Standard & Poor's, and Fitch, the three companies whose opinion determined whether a pension fund, a foreign bank, or a municipal government could legally buy a financial product. A AAA rating meant the investment was as safe as US government debt. It meant institutional investors with conservative mandates could buy it without restriction. The rating agencies gave AAA ratings to products built from mortgages issued to people with no income, no job, and no assets. The reason was not incompetence, it was structure. Rating agencies were paid by the banks whose products they were rating, not by the investors relying on those ratings. A bank that didn't like the rating one agency gave its product could take it to a competitor who might be more generous. The agencies knew this. They competed for the business, and the business went to whoever was most willing to issue the rating the bank needed. The result was a machine that transformed bad debt into AAA securities through a combination of complexity, financial engineering, and conflicts of interest so fundamental that the people operating the machine had every financial incentive to ignore what was inside it. Trillions of dollars of these products were sold to investors around the world. Pension funds, sovereign wealth funds. Regional banks in Norway and Germany and Australia bought them because three American companies with century-old reputations had stamped them safe. But some people on Wall Street knew exactly what was inside them, and they had figured out how to profit from the collapse. Number 4. The bet. In 2006, a small number of people on Wall Street had looked at the mortgage market carefully enough to understand what everyone else was ignoring. The loans were bad. Not some of them, most of them. The income figures were fabricated. The appraisals were inflated. The borrowers being approved had no realistic path to repayment. The entire machine was producing securities whose underlying value bore no relationship to the AAA ratings stamped on them. These people made a decision. Instead of warning anyone, they bet against it. The instrument they used was called a credit default swap. Think of it as insurance. You pay a small, regular premium. If the underlying asset defaults, you collect a massive payout. The buyer of a credit default swap on a mortgage-backed security was essentially saying, "I think this is going to collapse, and I want to get paid when it does." Michael Burry, a one-eyed doctor turned hedge fund manager, studied individual mortgage pools loan by loan and concluded the market was fraudulent. He bought credit default swaps against mortgage-backed securities in 2005, paying premiums that his investors thought were money being wasted until they weren't. His fund made $700 million when the market collapsed. But the most troubling version of this story was not the outside investors who spotted the problem and bet against it. It was the banks that were creating the products, selling them to clients, and simultaneously betting against them. Goldman Sachs structured CDOS specifically designed to fail, selecting the worst underlying mortgage securities available, and sold them to clients while taking the short position that would pay out when they collapsed. The SEC sued Goldman Sachs for securities fraud. Goldman Sachs paid a $550 million settlement and acknowledged its marketing materials contained incomplete information. No Goldman Sachs executive went to prison. This was not a market that had gone wrong through collective blindness. At the top of the chain, the people who understood the system most clearly had used that understanding to extract maximum profit while transferring maximum risk to whoever was furthest from the information: foreign pension funds, municipal governments, retail investors, the people who had trusted the AAA rating and had no way to know what was inside. All of it depended on one thing holding. House prices had to keep rising. As long as they did, borrowers who couldn't afford their payments could refinance. The machine could keep running. The defaults could be deferred indefinitely. In 2006, house prices stopped rising. When house prices stopped rising, the machine didn't slow down. It snapped. Borrowers who had been surviving on the assumption that rising home values would let them refinance before their adjustable rates reset suddenly couldn't refinance. Their rates reset, their payments jumped, and they couldn't pay. Defaults began. Slowly at first, concentrated in the subprime market, easy to dismiss as an isolated problem in a small corner of the housing sector. The dismissals didn't last long, because the mortgages weren't in one corner. They were everywhere, sliced, bundled, repackaged, and distributed across the entire global financial system in instruments so complex that the institutions holding them couldn't accurately calculate their own exposure. Banks that thought they held safe AAA assets discovered those assets were built on the same bad loans defaulting in California, Florida, and Nevada. The complexity that had made the product sellable now made the damage impossible to contain. Bear Stearns had two hedge funds heavily exposed to mortgage securities. In June 2007, both collapsed. The bank itself followed in March 2008, sold to JP Morgan Chase for $2 a share, down from a high of $170, in a deal brokered over a weekend by the Federal Reserve. Lehman Brothers filed for bankruptcy on September 15, 2008. It was the largest bankruptcy in American history. $600 billion in assets are gone overnight. The global credit market froze within hours. Banks stopped lending to each other because no one knew which institution was holding how much toxic debt. The entire financial system, the mechanism through which money moves between every business, every individual, and every transaction in the modern economy, seized up simultaneously. The Federal Reserve and the Treasury Department intervened with a speed and scale that had no precedent in peacetime. The Troubled Asset Relief Program authorized $700 billion to stabilize the financial system. The Federal Reserve extended emergency lending facilities to prevent the remaining major banks from following Lehman into collapse. Ben Bernanke later said that 12 of the 13 largest financial institutions in America were at risk of failure during those weeks. The stabilization worked for the banks. For everyone else, the damage was already done. 8 million Americans lost their jobs as the economy contracted at a pace not seen since the Great Depression. 6 million families lost their homes to foreclosure, many of them borrowers who had been steered into loans they did not understand, by originators who had no intention of holding those loans. The IMF estimated that American and European banks had lost more than $1 trillion on toxic assets. Global trade collapsed. Unemployment in the Eurozone climbed for years after the initial shock. The people who had built the machine walked away. The people standing underneath it when it fell did not. In the years that followed, the United States government prosecuted exactly one senior Wall Street executive for conduct related to the financial crisis. 1. Goldman Sachs paid $550 million. JP Morgan paid $13 billion. Bank of America paid $16.6 billion. The settlements were large enough to generate headlines and small enough to be absorbed as a cost of doing business. No admission of criminal wrongdoing. No executives in handcuffs. The banks that had been too big to fail were, by 2012, bigger than they had been before the crisis. The borrowers who had been steered into loans they did not understand received a $25 billion settlement from the 5 largest mortgage servicers. Spread across millions of claims, it amounted to roughly $2,000 per household, for people who had lost homes worth $200,000. The rating agencies that had stamped AAA on securities built from ninja loans continued to operate. The conflict of interest that had made their ratings worthless was left largely intact. Moody's paid $864 million to settle with the Justice Department in 2017. Standard & Poor's paid $1.5 billion in 2015. Both continued rating securities the following day. Congress passed the Dodd-Frank Act in 2010. It was the most significant financial regulation since the 1930s. It introduced new oversight mechanisms, stress tests for large banks, and consumer protections designed to prevent the worst lending practices from recurring. Wall Street spent the following decade lobbying to weaken it. By 2018, significant portions had been rolled back. The 2008 financial crisis is sometimes described as a perfect storm, a collision of bad luck, collective blindness, and systemic complexity that nobody could have predicted or prevented. That description is convenient for the people who built the storm. The loans were knowingly fraudulent. The ratings were knowingly inflated. The products were knowingly sold to clients while their creators bet against them. The warnings existed. Regulators, economists, and traders who had read the underlying data were sounding alarms years before the collapse. Those alarms were ignored because the machine was making too much money for too many powerful people to have any interest in turning it off. What happened in 2008 was not a natural disaster. It was the consequence of a system where the people taking the risks were not the people bearing the consequences. That system produced the worst financial crisis since the Great Depression, and the people who designed it largely went back to work on Monday. If you're curious about corporate breakdowns, subscribe for more, and click the link on the screen to keep watching.